We're still on. Are we still on Instagram? It looks like we're back on Instagram. I think we're good. Cool. All right.
Yeah. Okay.
Okay.
Second time's a
So
charm. Yeah.
yeah. So okay. So we were at like recession. So barely in a
Yeah.
recession, right? Like one bad quarter. Q4 was bad. Q1 was not horrible, right? It was basically. I mean, like obviously you want to see economic growth, but we're not. It's not like a massive drop in economic growth.
No, exactly. And just to recap, because we restarted this live, we're going to be talking about the jobs numbers that we saw. Of course, blockbuster job numbers, at least for Canada, the US. We're also talking about bond yields, how they're going, and just as you mentioned, recession. So, yeah, my initial thoughts on the recession. I mean, it's interesting just looking back and trying to find parallels in history. And I dug into that, and I know you did as well. So do you agree with me that the 1990s is probably the most similar? And there are some key differences, don't get me wrong, but the one that stands out the most is what we're potentially seeing right now.
Yeah, I think the 90s is a good comp. I mean, you had the population growth, like massive population growth in. I mean, the last time we set a population growth record was 1989. It was 1.4%, and the first time we beat that was 2023. You saw house prices go up 30%, double digits for several years in a row. Inflation was coming on pretty hard as a result of that. Population growth was running hot. People were piling into the real estate asset class, which we saw here in Canada in 2021, 2022. And then the central banks, basically in an effort to curb some of that behavior, started hiking rates. And I think a lot of people, they dismiss the magnitude of rate cuts in favor of the rate itself. Like, people will say, oh, well, it's different because in the 90s, rates went to 8% or whatever. And it's like, well, rates started at 4%. And so they doubled. And we saw the same thing happen in present day, right? They went from 2% to 5 or 6%. And so I think that the magnitude, like, because the market doesn't necessarily care, like, and the real estate market especially doesn't really care what your interest rate is. They care what their total interest payable is and how that relates to their buying power. And so if you had a comparable magnitude of interest rate hikes, which you did, then you would get a comparable impact. Just because the rate's lower doesn't mean that there's any material difference. Your mortgage payment was, as a percentage of household income went up comparably. Your mortgage payments are going to jump comparably on the 5-year renewals. And so that to me is kind of the setup. The one other thing I'll add is, you saw that big spike in immigration in 89 and in 23, 24. And then what happened was it organically started tapering off. Like, and policymakers started taking credit for it, right? They're like, international student enrollment dropped like 80%. And then they're like, oh, we're going to cap international students. Cause it's like, oh, there's an economic trend. We might as well take credit for it. Cause it's a populist thing. Right. And that was even the Trudeau government. That was before Carney. Right. And then temporary foreign workers, same thing. You started seeing temporary foreign workers because the promise of Canada's economy is no longer good. And so people stopped electing to join, to move here to try and join Canada's labor force and be part of the economy, or they started moving back, and you saw net negative non-permanent resident growth in 90, 91, and we haven't seen that until present day, where Canada's population is actually falling. So those things, I think, are what really tells me that the setup is comparable. And so the question is, like, do we end up with this long grinding recession that's not that bad on paper, right? Like, you get a couple of months that are okay, a couple of months that are really bad, and then you go to 4 years of very little economic growth. That feels worse to me than a fast recession where the central bank can come out with emergency rate cuts and try and stimulate their way out of the economy, right?
Yeah, exactly. And I found like an interesting paper from the City Howe Institute. And yeah, they were kind of looking at that, and you can see, and I do like that they did the quarterly GDP, but they also combined like 2 quarters in a row. So you saw, like, a bit like you were saying, it's not like it was super deep for the most part. It was kind of whipsaw a little bit. And the most interesting thing too that you didn't really touch on, but I know we talked about before that, is the employment rate. So you kind of see employment rate starting just kind of going in the 62% and going all the way down, slowly trickling down. And that's kind of what we've been seeing for the last couple of years. I know there's a lot of focus on the unemployment rate, and that's fine. If I had to choose between the two, I'd choose employment rate over unemployment rate in terms of a data point, just because the unemployment rate excludes people that give up looking for jobs. And I think that to me, that never sat right. It just, you give up because you can't find work, so you're excluded from the calculation. Like, how does that make any sense? I don't think it makes any sense. I guess their justification is probably like, oh, people are lazy that are in that category, which may or may not be true, and some might be leeching or looking to leech on the system. But what we're seeing is definitely the same kind of trend. So I was pulling the data here, and it's not as clean looking, but just to give a little bit of a perspective. So the employment rate kind of peaked around 62.5%, and that was in 2023. And it's been steadily trickling down, and now we're sitting at 60.7, actually went up from 60.5 in April to 60.7, but it's been below 61 now for better part of a year, essentially. Yeah. Since February of 2025, and been kind of trending sideways since, which is not the best indicator. And employment rate just looks at the workforce in, I think, working age, so 15 plus. So I do like it in terms of an indicator more than unemployment.
Yeah, I think, there's a couple of other ones like hours worked. Like when I started to find there was like a lot of volatility in the jobs reports, I would look at hours worked. I would look at payrolls, right? LFS and CEF, the payrolls lags a couple of months, but like if you catch it up, there's never been like a bigger disparity between payrolls and labor force survey, because labor force surveys, it's incomplete by nature, right? Like they call people and ask them if they have a job, and I think the sample size is like, what is it, 4,000 or something? So I've never got the call, but and then they cast it out over the entire economy to try and come up with an idea. So like, and you would.
There's a reason it gets revised all the time, right? So.
Right. Exactly. And so, I think that the reliability of the data is probably a thing. But even if we don't necessarily, even if we try not to discredit the data, let's say, I think, it's one good month after 4 bad months. I don't necessarily like it. It definitely makes the Bank of Canada's job a little bit harder. And it's not like, you were talking about Fed fund futures and how the market's basically pricing in hikes rather than cuts. But do we see, the Bank of Canada having any room to cut now after this jobs report? Probably not. I don't think they did anyway. I think the market's basically saying there's more room to hike than cut. But now they're forced to hold and wait to see if the Fed does anything. I don't think the Fed's actually going to hike, but they have hiked into oil price spikes and recessions before, so you never know.
Yeah, I think there's no chance for the foreseeable future, at least the Bank of Canada. What have we learned from Tiff Macklem since he's been governor, especially after the lower for longer, that whole debacle?
Very careful,
since then he's been one constant is, and you listen to Carolyn Rogers, is we will go with the data.
Yeah.
He said, if there is one thing they've said time and time again at every single press conference, I believe, is that they will act based on the data. And now they're probably seeing the data being pretty volatile, to be quite honest. And I think they'll just take their time. I think in their view is probably going to be less of an evil to just stand pat, see how things develop, and then react. Will they be reacting too late or reacting in the wrong direction? Very possible, but they'll justify it with the
Probably
data.
Not. Yeah.
No, but at least they can justify it, right? They can just say, you know what, we went what we saw in the data. Whether they have whether they're looking at the right data, that's another question. I think for the most part, banks tend to put a lot more emphasis on lagging indicators.
Yeah.
And then
I
they're a bit too late
think
to the
that
party.
they were like they were way too late in in the COVID era, like on inflation, when like when they were telling us that inflation was transitory for such a long period of time. It's like, well, even if it is, like, transitory it faster by hiking rates, like, let's not sit here and let it go to 9 when we're at 4, right? And that's what they did. And so, yeah, I mean, it would make sense that they would be more prudent to respond to data. Like, it seems like the right decision for them to be making right now, to be honest. And I guess the bigger question is, like, where's the Fed at, right? Like, we were talking a little bit about,
Yeah.
like, oil prices still, I mean, they're flooding the market with strategic petroleum reserves, right? So, but the Fed watch is like, what, 99% chance of a hike by the end of the year?
100%.
100% chance.
Not even 99. You'd think they'd give themselves a little bit of leeway, but if you, I mean, I'm not a mathematician, but if you add up the 25 basis point increase probability of 97.96 and the 2.04 50 basis point increase by then, pretty sure that equals 100.
So, I mean, I pulled up the chart so many times that I won't even bother again. But, like, Fed fund futures don't have an exceptional track record of being correct.
No, they don't.
So, like, I'm still comfortable fading this, to be honest. Like, especially with Warsh coming in, with all of the drama around Trump installing him basically because he was most likely to cut. Trump obviously wants rates to come down, but he's not behaving that way with Iran because the two easiest ways to get rates to come down are spend less money and don't go to war to increase oil prices probably right now, right? So, like, I could see that both all, like, the Fed and Bank of Canada are kind of stuck in a higher for longer environment and stuck sort of waiting for the market to give them data that allows them to justify stimulative policy, but I can't see them hiking personally. Like, especially if you look at the consumer, right? Like, the U.S. especially, but Canada is pretty disparate too. Like, in the U.S., I think like 50% of your consumer economy comes from the top 10% of people, and, like, the rich are just getting richer, but the working poor and the middle class is basically being inflated away or their debt serviced away, especially in Canada. Debt service rates are pretty high. I think you put some of the Equifax reports stuff in here, but
Yeah.
feels like to me that, like, they don't have room to hike unless they really want to blow stuff up.
Yeah, I mean, I think it's hard to disagree with you, but I think they tend to look, or I'm sure they look at all the data, but I feel like they tend to put a bit more emphasis on the aggregate data, the averages over the median, for example. And just to show here, the U.S. 2-year bond yield, this had the biggest move today. So it went, it keeps going up. So it's up like 13 basis point. And this one is important because typically this will be a good indicator of where the Fed's fund rate will be going. So this one is jumping at, it's 4.17. And it was, right around 4 before the employment numbers came out. And I think this is just, this is the market saying that, look, the employment numbers were better than expected. Oil prices remain pretty elevated. We're starting to get pretty concerned with inflation, and we think the Fed will start getting concerned too.
But so, like, oil-driven inflation is like super outside of the scope of control of the Fed, right? Like, or any central bank. Like, are they hiking to take steam out of the remainder of the economy so that it also doesn't put pressure on inflation to try, like, you're killing inflation with the wrong tool, right? I don't know, I could be wrong, but, like, monetary policy has nothing to do with oil prices, really. I don't, like, maybe not nothing, but not nearly as much as supply.
They can't print oil.
Supply chain.
Yeah. You're right,
imagine
but
they tried.
An argument for it, for a rate increase, could be that maybe they want to make sure inflation doesn't get worse. So it's maybe a way to contain it beyond that price spike. I guess that could be an argument made, because the last thing you'd want is, on top of oil inflation, is you get everything else starting to increase, regardless if it has oil input or not.
Yeah. Okay. Yeah, I think, like, the other piece is, like, we're just at the beginning of the agricultural cycle right now, right? So
Yeah.
all your fall all your fall food inputs are going up. So, so like fall food inflation should be a lot higher just because tractors are being filled with fuel costs that are significantly higher right now.
Yeah, exactly. And like, I don't know, everyone listening, but I don't know about you, Dan. Food does sure seem like it's not going down in price.
I think it's the highest inflation right now, right? 4.3% or something.
Something like that, yeah. So can you imagine if it's getting worse? Clearly, the bottom of the K will be struggling even more. And look, in terms of, just to touch on bond yields again, so the Canada 5-year has jumped as well today. So not as much as the US, but now it's up. Looks like it's up about close to 10 basis points, so 3.05 to 3.15. So I know that's one you keep a close eye on your end, especially when it comes to real estate.
Yeah, like your fixed rates are not going to be giving any relief to all the mortgages that are renewing this year, and your fixed rates are not going to be giving any relief to the buyers in the market right now. I mean, as it stands, like I don't know if I pulled this chart up, but I'll pull it up if I can get it up here. But CMHC puts out like your residential mortgage industry report, and they show what rates that people are taking. And your consumers right now are actually taking the variable rate most commonly, which I found to be kind of interesting. So consumers basically were taking 3-year fixed this time last year, and now actually mostly taking the variable rate. So consumers basically think that rates are either going to fall in 3 years. I mean, pricing aside, right? Obviously, pricing and maybe exit liquidity like aside, because a lot of people probably also take the variable, so they have the option to sell with a lower penalty. But if you set aside those two incentives, like if we're just assuming this tells us something about what consumers think are going to happen with rates, consumers are behaving as though they think rates are going to fall either immediately or at the latest within 3 years, so they can renew at a lower rate, right?
They're like you; they're just betting against the traders and CME.
Yeah,
they're just doing a contrarian bet. They're like, you know what? They're pricing at higher rates. We'll bet against that.
Well, I just don't like what scenario is where we like. I guess the scenario is like oil prices end up high and the consumer can absorb them, right? Like, but the market's like, if the market's pricing in hikes and inflation, like right now the oil, like you said, oil prices is down, but like the market's pricing in inflation as if oil prices are up significantly from where we are. So that's the part that's kind of confused me.
Yeah, I mean, you had, and I can't remember where I saw that, but apparently major oil, the majors, especially in the U.S., are starting to sound the alarm that supply is starting to run real low in terms of reserves and what was available. And they seem to be really concerned that we could see now like the oil shock really ramping up in the next few weeks. I'm just going on memory there, but when you have these CEOs that clearly know the market and have a lot of data available to them that are starting to sound the alarm, I think the market is still a bit too rosy on that side of thing. And I think you could really see that ripple into the economy. And obviously you talked about food inflation, but just the inputs. I mean, it was pretty clear, and we talked about it. I don't know if it was the last recording we did or a couple of them ago, but you are starting to hear major companies that are outside, they're not in the oil sector, and I mentioned Walmart, that are saying, look, we're starting to see pressure on our costs. It's starting to trickle through, and this can't last that much longer until we start passing prices. So at some point it's going to happen, and it's probably going to start happening in Q3, I would say, like substantially, if I had to guess.
And so then the question is, can the consumer survive that inflation? Probably more in the U.S. than Canada, but even in the U.S., like, I don't know, like if you look at your outside of the 50% of consumption that is from the rich, like can your lower 20 or lower 80% of the economy withstand a 5 or 6 handle inflation rate? I don't see that happening.
I don't think so. I mean, they'll have to make trade-offs, right? Like at the end of the day, that's what you do. Like if you need gas for your job, then you're probably going to be cutting elsewhere.
Yeah, well, like
Or
less vacations,
yeah,
right? Like less luxury goods,
hmm
less discretionary expenses, and but that's still contractionary on the economy, right? Like how are you still of the opinion that we see demand destruction and rates are more likely to come down than up, or like
Well,
are you
the
is the
problem
CMA?
is, yeah, the problem is you have, yes, like I think what you're saying are all valid points, but is that offset by the top of the K, and also is it offset by the massive amount of spending that we're seeing in tech right now? I mean,
Yeah, well, and
it's project,
that's
yeah,
that also is, like I mentioned this on our last week when the AI stuff is, that also materializes massively in government spending for infrastructure. Which, so if you're a bond trader, you're like, I can charge these governments whatever I want, like, I could like on the rate, right? Or I can pay whatever I want for bonds. I can get them as cheap as I want because they need, like, it's very clear how much money they're going to have to spend to do all of the things that they want to do.
yeah, and they're big amounts of money. Like literally this year, I think they're on track to at least, like, I think I talked about the big five names that are spending on AI infrastructure. So you have Microsoft, Google, Meta, Amazon, and Oracle. I mean, they're well on track to exceed 750 billion this year alone. So is it a stretch that they'll be spending $1 trillion next year? Probably not. You're seeing Google tapping equity markets. So now Google probably is starting maybe a trend. I'm not quite sure, but they even announced today that instead of tapping 80 billion, they've increased that to 85. Berkshire was one of the companies that kind of they got a deal done for 10 billion worth of that 80, but it's also showing that they're tapping the equity markets, the debt market, and their own free cash flow. And that spending is not coming down anytime soon. So clearly, that is a big plus for the economy. And that's why it's such a weird time right now, because you have like massive spending bring up the economy, but then you also have pressure on the other end on consumers and households and businesses that need
Yeah.
oil as an input, and more have to restrain their spending. So it's just really hard to gauge where this is going. I'll be very honest.
Yeah, 100%. What was some of the other stuff you wanted to chat on? I think you put the Equifax report in the notes. Jobs.
Yeah.
Did we cover jobs? I guess, like, jobs. Anything
You
stand
want to
out
go
you
over
there?
it? Yeah.
So jobs. I mean, a lot of private sector job growth, which, like the last couple of positive employment prints have mostly been public sector and mostly part time. And so it was easy to poke holes in that they weren't positive. This is like a pretty clean positive print.
Yeah.
Biggest gain was construction, so that kind of tells you, okay, well, I mean, they are seasonally adjusted, but beginning of your construction season, like May hiring is typically all your furloughed workers come back, start working on site. So there's that piece. The biggest loss was in retail, right? So as the consumer tapped out, or if retailers are starting to reduce spending on labor. Those kind of stood out to me. Youth unemployment still scary high. I think that one bothers me a little
But
bit.
it improved.
It's improved. It improved.
Yeah,
Yeah.
it improved. Yeah.
Yeah. And I think that's an interesting one. Like, you look at your temporary foreign workers, right? Like, temporary foreign worker population decreasing. Tim Hortons came out, right? What was the Tim Hortons thing?
10,000, I
like,
think.
Yeah. It's like funny because I mentioned earlier, like, that how policymakers kind of start to take credit for a lot of these, like, organic things that are happening in the economy, and like Tim Hortons is doing the same thing right now,
Yeah.
where they're saying, we're going to hire locals and scale back our temporary foreign workers. But that, like, youth employment is such a clear read on the impact of temporary foreign workers, right? Like, all the jobs that you and I used to do when we were kids, like, and our friends, right? Like, work at Tim's or like work at McDonald's. Like, I remember growing up, we would like all go to McDonald's and like order a bunch of crap to like mess with our friends or whatever, right? So, and now, like, I never see a kid working at any of those stores. So that temporary foreign workers coming down. Tim Hortons now saying they're going to start hiring locals, because they don't have temporary foreign workers to hire from anymore, I think, right? I just thought it was kind of funny.
Yeah, I mean, I think it's going to help, right? Like, I think I worked most of my time through university in college. I did not work at Tim Hortons, but I worked at Pizza amongst other places. A lot of part-time job, guide in a museum too. So those are great jobs when you're in school to be able to work part-time. And I think, I think Tim Hortons just a latest example, I think it's just good PR that they're doing it, but it also raises questions like why were they using it so much in the
Well,
last
like
couple of years?
yeah, like nobody got worse PR than them for it, right? Like
Yeah.
and it's palpable, like you can see it and feel it, like you know when you're in a Tim Hortons, and I mean to the point where like people were using terms like Timmigrants, and like that's the whole temporary
Oh,
foreign worker
really? Okay.
policy that they
Yeah.
were, yeah. So like they got, they had a massive. I mean, somebody even just said in our
The
comments here,
comments. So yeah.
it says boycott Tim's, right? And then
Tim.
yeah, Tim Who, and so it's kind of like it's funny in that regard. Like they were really nobody was a worse beneficiary from the PR of the temporary foreign worker program than Tim Hortons, but they're aware of it and now trying to walk it back. Anyway, other anything else on unemployment? I don't really think so, to be honest. I think that I'm interested to see if it gets revised, and I'm interested to see what payrolls end up at for that month, because they are pretty disparate. I'll try and find the chart from Ben Rabideau, but like payrolls and LFS are so far apart right now. Like they've never been this far apart. So
Yeah, yeah, and I mean, what's interesting too about the survey is government saw a 20,000 increase. So I thought they were supposed to reduce
so much
that.
for our layoffs.
Yeah,
Well,
exactly.
it is interesting though, because like it's all accounting, right? Like it's just because like so Carney is like reducing the public administration workforce, but he's hiring on like infrastructure and spending it on capex. Like I mean, he's obviously talented and pretty brilliant
Yeah.
investment banker. He just like literally was like,
He's very
Let's
creative.
see if
Yeah.
they're gonna. Well, and I
Yeah.
honestly think like the average person isn't gonna catch that like the jobs are just moving from OPEX to CAPEX. Like maybe not the same
Yeah.
people or whatever, but like
Didn't he do that for the budget too? He's like, oh no, we're looking to almost balance the OPEX budget, but
Yeah.
the
Yeah.
deficit is mostly because we're just spending on CapEx. And like,
yeah, it's
okay,
brilliant.
like,
It's pure. It's investment banking 101, man. It's just creative accounting, and like I mean, honestly, like if you can sell that to retail investors and funds, in 90% of cases you can, right? Then as an investment banker, then you're probably going to have a hard, equally easy time selling it to the voting public in a place like Canada. I mean, his approval ratings are like like super high, and so like it's just funny, right?
it's also
Anyway.
funny. He keeps taking jabs at the Trudeau government before,
Oh, yeah.
like just he just. It's. I mean, I find it hilarious because it's still the same party, but I guess they have taken a different direction. But I guess you were talking about the Equifax survey. So Canadian consumer debt. So that came out. That was for Q1 2026. So Canadian consumer debt was up 3.8% year over year, reached 2.66 trillion. But non-mortgage debt fell by 487 million. Overall, it seems like Canadians are trying to rein in the debt a little bit. New credit card originations hit a 4-year low, but there was growth in the subprime and near prime segment. So that's not the best kind of news, just because it also shows that bottom of the K may be needing a bit more credit, but it's also the more at risk people, and you're also seeing the delinquencies rise. So the 90-day delinquency rate by balance rose over 4% year over year, and by volume it rose by more than 2% year over year. So overall, it's not it's not the most encouraging survey. Missed payments are not exploding, but they still remain elevated. In the quarter, 1.5 million Canadian missed at least one credit payment for Q1. So that's
Did
about
you see that
one.
Bank of Canada report? I think I sent it to you. Like
Yeah.
consumer path to mortgage delinquency.
Yeah. So do you want to explain, or do you want me to explain what that is?
Yeah, I can explain it, because I think it lends itself really like well to this. So so basically, the Bank of Canada put out this report called "Consumers' Path to Mortgage Delinquency," and in it, I mean, it's basically like it's a staff working paper, so it's a lot of like pretty heavy like math and economics, but basically what they show you is like on the path to somebody going, it shows like people who end up being delinquent, which is your solid lines here. It shows the rate of credit use, so like how their increase in credit use creeps up towards them, and it's credit cards and then personal lines of credit. And then this is the crazy one, right? Like it shows you how they start piling on, or this is the delinquency rate, and then they also have the utilization rates, and how they start basically just like ramping up. So what happens is people start going delinquent on credit products like the ones that you just mentioned. They their credit gets damaged, or first they rack up a bunch of credit card debt, and then they, if your credit utilization rate goes way higher, then you your credit's already like starting to get damaged, right? And then eventually you go delinquent, and then your credit's really damaged, and so now you have no exits, right? So if you do end up going delinquent on your mortgage, or you're tight eventually, like, why are people racking up credit cards? Well, they can't afford life, and because their mortgage payment's too high or whatever, so they start piling on and dealing with inflation by taking on debt. And then eventually they run out of room, and they can't pay their mortgage. They can't refi out, right? They can't you can't get more debt because your credit's damaged from piling on too much debt, and then you end up going delinquent. And this lends itself to the Equifax report that you just mentioned, and I'll pull up some charts from that as well because there's some that stood out to me. But we're just seeing, and that process takes 2 years based on the Bank of Canada's analysis.
Yeah,
right?
that was the key point. Yeah,
we're just seeing the beginning of the rise of utilization rates and delinquency rates. That to me is like, okay, we're just like, we're not even
of non-mortgage debt. Yeah,
but we're not even close to peak mortgage delinquencies.
Yeah.
If those indicators tell us anything.
Yeah, I mean, it kind of confirms what a lot of people have been saying for years is people will make their mortgage payments until they really can't, right? So they will stop making other payments well before they can't make their mortgage payments, and that paper essentially confirms that. But was really interesting is what you mentioned is kind of that 2-year gap that they found, and really the one of the big takeaways from the Equifax report is things are not looking good in 3 specific provinces, and I know you know which ones they are, but it's Ontario, BC. The third one, I was kind of surprised. I guess I don't pay as much attention to Manitoba, but Ontario, BC, so the 2 provinces where the real estate really got out of control, I guess. You tell me whether that's an appropriate term or not. And then you have Quebec, Saskatchewan, Nova Scotia, and New Brunswick that actually improved on those delinquency rates.
Yeah. I mean, Ontario, like the Ontario delinquency, and also they had, I got to find it. So where was it?
They should have Ontario X GTA and GTA.
Yeah,
I feel like that.
Should,
yeah, I feel like that's probably skews things because, I mean, Ottawa's market has gone down, but it's. I feel like it's kind of weird to group it with Toronto.
I mean, look at your 90-day delinquency rates on mortgage here. So 90-day delinquency rate in Ontario versus everywhere else in the country. It's just it's just astounding, right? I mean, BC,
Ontario and BC,
but BC's like, it's it's like it's there, but it's still below the national average. I mean, I guess the national average is obviously just purely skewed by Ontario, but that's like all households. But yeah, it says Ontario and BC face the strongest and most persistent increase in delinquency rates. I mean, the jump up here is just massive in Ontario. And there was another one that showed, where was it? It was Ontario homeowner. There it is. Homeowner insolvency volumes jumped by more than 11% from the previous quarter, with over 90% of these individuals choosing consumer proposals over bankruptcy. But homeowner insolvency volumes up 11% quarter over quarter, not even year over year. So in a 3-month period.
Yeah.
Scary, man. For Ontario, it's not scary for but it's not looking good for Ontario.
No, exactly. And another survey that kind of confirms similar thing. It's a bit different, but it's I don't know if you looked at that one, the MNP Consumer Debt Index.
Yeah.
And still same kind of thing, right? Canadians are still feeling financially squeezed. The debt index held steady, so they have a way of calculating it. I won't go into detail there, but there's definitely cost of living pressure points. So one key point here is 73% of those surveys say they're cutting back on spending. And they're saying also around that same percentage that rising prices for essentials like food and gas are straining their finances. And that's that starts to get concerning. And there's 43% of Canadian that are $200 or less away from financial insolvency. So that kind of ties into that Equifax survey, that there's still a big chunk of the population that is in a pretty tight spot, despite, you know, some encouraging job numbers. I think that's more of a, yeah, it's better than bad job numbers, but it still won't make up for a lot of the data points that we're seeing right now.
Yeah. That's my thought too. Is like, there's no, like, other than the job sprint, there's really no bright spots in Canada's economy right now. I think it just takes time for it to accumulate negative data points. I still think the Bank of Canada is stuck though. Like, I think that they're stuck. They're not, like, even if we get, unless we get like, okay, this is a clear economic emergency and we're willing to sacrifice the Canadian dollar to solve it, they're not going to cut ahead of the Fed. I think, right? Like, and we just don't have that yet. I think we're gonna have a steady grind down of, you know, some things getting worse, but not bad enough that they're gonna come out swinging. That's my read on Bank of Canada's positioning right now. What do you think?
Yeah, I think so. I mean, again, I think it goes back to Tiff Macklem, right? He was there during the last bout of inflation. When we saw inflation spike. What did it spike to? Like 9%, 8 point something?
I think it was 9 in the States. Like, CPI always reads like about 20% lower than the US basket. It's funny because, like, when, you know, like when the government was like, oh, we have the lowest inflation in the G7, it's like, well, like, they're not, like, CPI isn't the same in every country, right?
No,
like, so you can't,
exactly.
like, you can't say that, right? Like, but yeah, I think we peaked in like the 8s and 9s. I think it was 8.
Yeah.
Peaked in the 8s
So,
in Canada.
do we really think Macklem will want to risk having another bout of inflation? Even if he can't really control it, he's going to probably try everything he can to control it. Even if we're starting to see a whole lot of indicators showing that there's a whole lot of stress. Canadians' household are indebted. I think, what was it, 177%, the latest.
But that's their problem, to be honest. Like, that's the thing. Like, like his problem is inflation. Like, his mandate is to control inflation. That's it. Like, he doesn't care if like, realistically, it does suck. It sucks for all those people that they can't withstand higher rates. But, like, it's not his mandate to save homeowners, right? Like, the Fed will do enough on a policy perspective to try and do that. I think that they will try and they'll try and soften, like, they'll try and do a soft landing to not overshoot and cause deflation, right? Which, I like, deflation is probably not a likely outcome, but like too little inflation, I think. But I can't see that. Like, I can't see him all of a sudden caring and empathizing with all of these you know, people who just levered up and you know, had horrible, like, you need economic Darwinism to take place. You need people to realize that those models aren't safe or sustainable, and that that's not a good way to behave as a consumer, in order for our economy to heal and go back to, you know, a proper growth scenario. And we, like, unless I'm wrong, like on the math, like, we can't really grow as an economy with our household debt to income at 177% unless the like, the return on capital that you can get from the economy is higher than the return or the cost of capital that you're borrowing your 177 debt to income. So your wage growth needs to outpace that. Your GDP growth needs to outpace that, and neither of those things are taking place right now. So we're always going to have to pay, or you have to face the music, or whatever the right term is, at some point, because you're borrowing from your future self, right? And right now we're just getting to the point where we're, like, kind of paying. We're paying the price for the debt binge that we started when Carney was central banker, really. Like, you know, 08, everyone else deleveraged and Canadians started levering up. I don't see how we get our way out of this unless Canadians start to deleverage, and they're not behaving. They did. I was feeling, like, hopeful when we came down from, like, 188 to 173 or something, and then we just started up piling on more debt, man. I'll pull the chart up. It's like, holy crap. Anyway.
Well, I mean, I think a lot of people are just stuck in that situation where the only option or at least, I mean, that they think they have is just using that to pay debt, which is never a good situation to be in.
Yeah, you can't solve a debt problem with a debt problem. As far as
I know. I mean, but that's what governments do, right?
And Canadians too. Like, you know, we keep like look at this chart, right? Like go to '08, like UK and the US. Look at the deleveraging that took place, and then look at Canada. Like we just started climbing. That was like when we just started our addiction to credit, and so we if we keep as individuals keep piling on debt, we also have the same problem that the government does, which is at some point you got to pay, unless people are just assuming that they're just going to outlive the debt, and like, oh, whatever, it's my kid's problem, or like, my state's problem. Like, sorry kids, we're not as rich as you
Well,
thought.
I mean, you can deflate it away, right?
That's
With
yeah,
high,
yeah.
that's yeah. If you have a high enough inflation and wage growth, you can definitely deflate that debt away, but then that has other consequences. And we had a question like, what would happen if Canada said we're broke and your bonds are getting chopped in half? Sorry, I mean, it's a good what if. It would never happen because they will print before. I mean, historically, not just Canada, but countries that can issue their own currency, and especially issue bonds in their own currency, they'll never pretty much default, right?
Well, they all like nobody comes out and says it, but they all believe in modern monetary theory, then that they can just print money into private savings, and that's good for the economy, and that they will eventually have the mechanism of being able to tax that wealth back out of the economy. But like I don't think that any policymaker believes anything else, right? Like ever since that modern have you watched the documentary on that, by the way? I think
Which one?
Finding the Money, I think.
No, I
can't remember
haven't.
the name
No.
of it. It's so good, man. Like to just understand. Like I don't believe that modern monetary theory is like a good policy choice, but like the math of it is obvious. Like it's like, yes, like if you print money into and it goes into private savings and it gets yes, it's obviously going to exacerbate disparity. That's the problem, but it's also not false. Like it's they put money in there and then everybody ends up getting richer, like, and the economy ends up being more productive because you create the thing and then you measure the economy with the thing, right? Like, I don't know. It's just kind of funny.
But you think, I don't think it would have ever happen. I mean, what would happen if it was chopped in half? Probably a pretty severe recession, if not depression, right? Like, I think it would be long term, it would probably be a better outcome than just inflating the debt away and ever so
Right.
increasing the money supply and inflation. But no politician or central banker in Canada I don't think they would ever want to do that. Like they'll
Yeah.
always choose the soft default, which is another way of just creating inflation, devaluing the debt over long periods of time. That's why there's an inflation target. That's why price stability is. I'm not sure why they use that word. It just makes no sense. Like stable prices does not mean they increase 2% per year.
Right.
It means they're stable. It's just I laugh every time they talk about that because like how can you talk about stable prices? Like
Yeah.
it's not.
Yeah, these guys need to hire branding experts.
Yeah.
What else did we want to get through that we haven't covered yet?
I think one of the really interesting things with the setup right now is just the trade realities. Like obviously the Canada and US are in trade negotiations right now, but the Canada-US free trade agreement came in effect on January 1st, 1989. So that was a new trade relationship. Of course, it was very different back then. We were accelerating globalization, which started more, I think, in the 80s. And then that accelerated, of course, in the 1990s. But the reality, it was a different trade environment to what we had been used to. And I think now we're just seeing the other end of that. We're going from, a lot of dependence on the U.S. and Canada was much less dependent on the U.S. prior to that Canada-U.S. Free trade agreement became more independent as a side effect of that. And now we're kind of seeing the other side of things where we're trending towards more protectionism, Canada trying to make trade relationships or divert some trade with other countries other than the U.S. But it's still different trade realities.
It's just logistics to me. Like it's so easy to say like, oh, we should diversify our trading partners. Like, what we should diversify before we diversify our trading partners? Probably our economy, right? Like we should also make interprovincial trade easier. Like sure, should we trade other places? where it makes sense. How many cases does it make sense? Like, where can we actually be competitive with our currency, with our labor costs, with the costs of our goods, and the logistics costs of getting goods halfway around the world, right? Like from either Canada
with their natural
or,
advantages too, right? Like
right.
it's
Yeah. Well, and like, and then, okay, like let's say we want to start processing and refining our oil and trading it to other places from Canadian ports. We don't have the ability to process our own oil. Like it goes to the U.S. and then the U.S.
yeah.
makes the money exporting it. So, it's like we're not. I don't. It's just like the logistics are, to me. It's like, do you want to drive something across the border or put something on a train and push it across the border at a way lower cost per good, or do you want to put it a bunch of them on a ship? And don't get me wrong, like shipping is actually a very cheap way to move goods, but it's still not logistically the same as pushing something across the border on a train. And that, I think that it's just like, yeah, everything makes sense other than geography.
Yeah.
To me, I don't know. It's hard for us to be competitive. That's the easy way to say it. It's not a stupid idea. It's just very difficult for us to be competitive in markets that are far away. Whereas it's way easier for us to be competitive in a market that we're very close to.
Yeah, for sure. I mean, on the oil front, we also shot ourselves in the foot for a few decades in terms we could have been very competitive, and especially I think right now we have a window of opportunity with what's happening in the Middle East. We talked about that quite a few times, where even if you're not as competitive as what is available in the Middle East, security of supply, just countries are putting more and more premium on that, and they're willing to pay a premium if they can secure a supply, a more consistent supply. And it is something that we'll have to see whether the Carney government comes through for that. But I mean, my whole point there was just to show that, yes, there were some trade uncertainties back then. It was different than right now. I think Canada benefited as a whole a bit more, but there were definitely industries, especially manufacturing, that took a big hit because things were just more efficient in the U.S. And they lost jobs to the U.S. So there you saw some disruptions back then. And of course, right now you're seeing disruptions because some industries just can't be as competitive when their main market is the U.S. when you factor in those tariffs.
Yeah, I think, I mean, you go back to the 1990s comparison where we started at the top of the show. And like, I think that period of time was when Canadian manufacturing basically got hollowed out, right? Because of comparable economic setups. And then I think what was remaining pretty much got crushed in 2008 when the Canadian dollar was trading higher than the USD for a period of time. And like, why would anybody buy from a Canadian consumer when the currency, you had the exchange, like your Forex just made it uncompelling. So, yeah, it's a weird setup. I think we're not in an exceptionally compelling, like to imagine that we're going to, resurrect Canada's economy on a manufacturing basis just doesn't make a ton of sense to me. I feel like it really has to come from natural resources. Like, why don't we lean into where we are the most well positioned on earth to be successful, or second, or I think Russia is the only place that has more.
Yeah.
I think we're number two. Yeah, Russia has the most, but like, I don't know. It doesn't seem like a lot of people want to trade with Russia right now.
No, and I guess maybe a way to finish it. I know we talked about government debt, but I have a question for you. How much flexibility do central banks have, like whether it's the BOC or the Fed? I mean, governments are spending. Like, are we just not entering a fiscal dominance?
That's what I've said for a while.
Yeah,
like, I felt like we were in a period of fiscal dominance. Like, who was it? I think it was Powell when, I can't remember who was Treasury Secretary. Was it Yellen? And he was like, they were talking about rates, and he's like, I have to remind you, like, I'm not the one spending the money, like,
exactly.
And I agree, man. And this is like where governments are. I mean, Rich Diaz from the Loonie Hour podcast makes this point all the time. He's like, a really good way to, it's obviously not going to happen, but a really good way to reduce the cost of borrowing is stop spending like drunken sailors. Like, stop, like, it's a pretty easy way to do it. So yeah, is the Fed losing control? I mean, in the U.S., like clear fiscal dominance, I would say, and it's clearly the inflationary force. How much can they do with the Fed funds rate to really slow that inflationary impact of all the spending? Probably not a ton. Canada, the same thing. I mean, you literally have a former central banker of two of the largest economies in the world running the fiscal side, and believing that he can call the shots and behaving as such. That's going to change the effectiveness of both or at least in Canada, the effectiveness of what the Bank of Canada can do with the policy side.
Mm-hmm. Yeah, because if you start including provincial government debt along with total government debt to GDP, like it is much higher than right now than it was in the 1990s.
Yeah.
A lot of people focus on the federal debt, but let's be honest, like if provinces start defaulting, do we not think the Bank of Canada won't step in as a buyer of last resort? Of course they will.
On sub-sovereign, yeah. Like, it is funny because Canada always says like, oh, like Canadian policymakers are always like, oh, we have the lowest, the sovereign debt in the G7 or whatever. It's like, yeah, well, because you're excluding sub-sovereign debt. Like, it's like that would be like saying the EU has the lowest sovereign debt in the world because they're the EU, but you forget about all of the other countries, because like the way that our debt structure is set up is that we have the sovereign and sub-sovereign similar to the EU, right? So I think it is, man. I mean, it's like
they would of course step in, though. They would step in. Like, there's no chance they wouldn't.
Or the Fed would, and then like they would do some sort of swap where the Fed would step, like the Canadian federal government would step in, backstop the provinces, and then the central bank would backstop them.
Yeah, it's all. But that is essentially the setup we're in right now. I mean, there's no way. And look, I can understand Carney in terms of the spending and those projects and building Canadian resiliency. Like, look, I think there's some good arguments to be made there, but the more you spend, the more this becomes unsustainable. Like, has to be a release valve, like somehow, right? Either it's going to be the currency or it's going to be the debt market. Like, something will have to give. And at some point, they will have to choose.
Or the release valve is that you're crushing the population who cannot afford the the consumer is ultimately like who pays for the budget, right? Like, who pays for deficits? Consumers. Mm-hmm. And so the release valve is that you have to tax consumers more, and consumers are the ones who actually have to bear these higher rates. Like, again, who services the debt? Well, taxpayers do. Right. So that's the current release valve. And how long can they push the consumer by eroding their after-tax income and eroding inflating their cost of living? We're about to find out, man, because they're not stopping, honestly. And I think, historically, this this always leads to a revolution. Not to say that I don't think we have a revolution in us in Canada, but historically, like, you get disparity of this level. When do you get to civil unrest and all this stuff? I don't know. It's weird. It's like, yeah.
Let's finish on a positive note. Anything positive you're seeing in the in the markets right now?
Jobs print was a bright spot. It surprised me to the upside, and I won't try and belittle it. I think that's good. I think Canada's AI strategy was interesting. I'm curious to see how that plays out. We can talk about that maybe on another episode. But I would say, like, if we can figure out how to get past our own bureaucracy and red tape, I feel like Canada could actually do exceptionally well with a lot of these nation building projects. Are we going to do that is the big question. And I think Carney clearly has a pretty low tolerance for BS and the bureaucracy, et cetera. So is he going to start like really, really using more strength to push through some of that crap because otherwise he's going to run out of room to actually execute anything within a term, he talks about like all of these projects. It's like, well, those projects take 3 years just to get permitted, and you need to spend millions or billions on consultants and this and that and blah, blah, blah. And, do we see positive direction in Canada becoming less bureaucratic as a result of that? Probably. That would be my hope. That's the bright spot, I think, right? Is that nation?
Yeah, I think so.
Yeah.
And I mean, we've talked about a lot about spending, and honestly, look, at least right now we're seeing, I think we've been spending a whole lot over the last decade plus. At least now, I think we're spending on things that will probably provide some long-term benefits to the country, or more significant than what we were doing like 10 plus years ago. So I think that's a positive for me. And the other positive, if people looking at stocks, I mean, the Nasdaq's down 3% today. So
Stock
if you're
sale.
looking,
Let's go.
yeah, stock sales. So I'm not saying that stocks are, especially not tech stocks, are cheap, but it can create some opportunities, right? So on the Canadian Investor Podcast, like we talk about investments. So there could be some good opportunities, especially right now, because just a good job print can do that, can bring the markets down. So it's a kind of good news, bad news type of deal.
Yeah, 100%. Cool. Yeah, let's leave it there.
Mm-hmm.
And I'll see you again next Friday. Thanks for everybody tuning in. These lives are fun, man. We had a couple of people say, in the comments, thanks for everybody who was there, like in the comment section.
Yeah, thank you for joining.
That they like these unscripted episodes. So I guess we'll have to keep them up.
Yeah, it's funny. Like I spent like 3-4 hours researching yesterday, and I think we only covered part of it, but it's still fun. Like even if we don't cover all of it,
yeah, we got enough material for next week anyway. I mean, it's not like let's leave it there, and we can cover the rest of it next week.
Sounds good.